Welcome. Glad that you're here. It's the Strategic Trader class. I'm excited that you're here. This is the first step, the first session of many. And the idea of this Strategic Trader class is to help build the foundation for better trading and investing. That's what this is. You build your house on a rock, not on sand. And we have to have a solid foundation in order to grow and in order to excel. And that's really what this entire on demand series is designed to do. It's to give you that foundational support, the level of success that you need to help you take your trading and investing to the next level. If you've never pushed a buy button or a sell button, you've never known anything about the markets, that's okay. We want to start you from the beginning so that you can utilize the financial markets the right way, starting early. Maybe you're a wounded trader and you've done this before. That's okay too. Hopefully, some of the stuff that we go over today, what I ask you to do is especially keep an open mind, right? Keep an open mind into how we look at the markets and how we think about the markets. So, this is session one. Now, in session one, what we're going to do is really it's all about introductions, right? Introductions and really understanding the concept of perception and reality. So my name is Chuck Fulkerson. A little bit of background on myself. I've been trading since 2005. So I started trading in 2005. And when I started trading, I didn't know the difference in a stock and a rock. I was brand new to the financial markets. I remember my first trade was at a brokerage firm called Options Express. Many of you may know it. They're still around today. I took my first ever options trade, Merrill Lynch, and I made $40. I was so excited. Spent 30 in commissions, but right there I said, "Wow, this is pretty cool." Right now, my background way back then, I worked in the restaurant business, right? And so working in the restaurant business, I had a strange schedule. I was working all odd hours, right? Nights, weekends, holidays, all that stuff. But it did allow me the ability to find a couple of hours a week, sometimes even a couple hours a day, in order to really sit down and learn what I needed to learn. And that's really what got me started. And I started off as an options trader. Options are a tactic that we use in order to enhance our probabilities. But before we have a tactic, we first have to have a good strategy. And one of the things you'll hear me say this all the time is that every good options trade first starts as a good stock trade. So before I ever really understood, the right ways to trade options, I had to really understand the best way to find good stock ideas. And so started as an options trader, eventually became a futures trader. Once I started really trading futures and getting into it, I found myself really, really excited about this and found myself in a position where I could teach others how to do it. So I had the pleasure of traveling all over the world. I've taught thousands of people in, Singapore and Dubai and London and New York and LA and Chicago and DC, Atlanta, Dallas, Houston, Pittsburgh, all over the country, all over the world. And here's what I found. Doesn't matter where you are, doesn't matter who you are. Everybody's got the same goals. They want to choose the way they live their lives. And that's what the knowledge of trading affords you to do. And so what I'm going to do as we go through this is I really want to give you as solid of a background as I can to help you utilize some of these skills and some of these tools. So let's go ahead and dive right into it. And the first section we're going to talk about is perception and reality. A little bit of a key about perception and reality is that reality will always win. But we only have access to our own reality, right? So I tell a story. And the story that I want to tell, I was actually running a financial education center in Phoenix, Arizona. And I was probably in my late 20s at the time. I had been trading for a while. I wasn't an instructor as of yet, but I was running a financial education center in Phoenix, Arizona, and I didn't live in Phoenix. I was commuting. My wife still lived in Pittsburgh, PA. That's my hometown. And I was commuting back and forth from Pittsburgh to Phoenix. So I just had an apartment in Phoenix. And so I didn't know anybody. I didn't have any friends. I didn't have any family. I didn't know anybody in Phoenix, Arizona at the time. Turns out I did actually have a cousin that lived in Phoenix, and we wound up becoming very close, which was awesome. But this was like my first week in Phoenix, and I didn't know anybody. So I took over an office, and the office that I took over was an office with about 8 or 9 employees. Now, this particular office I took over and was now running the new division and the new team. And one day, I came into work, and I walked by Kathy, and Kathy worked at the front desk. She was our receptionist, secretary, administrator, the jack of all trades. Frankly, she was amazing. She did a phenomenal job. I absolutely loved working with Kathy. And one day, I walked into work, and I was furious. I was just upset. I was furious. Now, a little backstory: we had lost 2 employees because 2 employees, as soon as it, kind of, sometimes in business, a new regime comes in, they take over, and some of the older employees leave, and so 2 employees had already left. Not by my choosing; they had left on their own, but they had left, and so I came into work, and I had had just a morning, just a terrible morning. And as I'm walking, and I walk in, and Kathy's sitting at her desk, and I said, "Hey, Kathy, I need you in my office in the next couple of minutes, please. Can you come to my office? I need some help." That's all I said, and she didn't come. I'm sitting in my office. It's like 15 minutes, and I'm on the internet and looking at a couple of things and getting my day started. Already having a bad day, and she's not there. So I go out and I poke my head around the corner, and she's not at her desk. So I didn't understand what it was. So I walk out to her desk, and then I see her at her car, and she's packing up. She's packing things away. And I said, "Kathy, what are you doing?" She said, "I'm I'm leaving." I said, "Why are you leaving?" What? She's like, "I assumed you were going to fire me." I said, "Oh my God, no. No, I wasn't going to fire you. What made you think that?" She said, "Well, you walked in and you were so upset and you were so angry. I assumed that you were going to just let me go and fire me. I mean, I so I was packing my stuff, and I said, "Oh my gosh, I don't know. I feel terrible if that was your perception of what was happening." Matter of fact, my car got broken into this morning, and somebody stole my radio, and they broke my car window, and I don't know who to call. And I thought that maybe you could help me figure out who to call. See, perception that Kathy had was her own reality, right? Her perception became her own reality. And her own reality was, I was going to let her go. My reality was, oh my gosh, I'm having a terrible day. I need help. And so everybody's perception becomes their own reality. Okay. And we take actions based upon our perceptions, right? We take actions based upon our perceptions. So think about that story, and we've all had that story happen at some point in our lives or something similar to that. Chuck, what in the world does this have to do with trading? Well, when we think about trading and investing, there's always two distinct sides. We have buyers and we have sellers. That's it. I don't care what market it is. Every market has to have those two distinct sides. There's got to be the buyers and there's got to be the sellers, right? Those two distinct sides are the ones that really matter. So what we have to always think about, though, is that there's two distinct groups. And a lot of people think about buyers and sellers, but they don't think about the groups. And the groups are the professionals, the banks, the funds, the brokers, the hedge funds, right? All the people moving all the money. And then there's the amateur traders and investors, the people that are on what we'll call it Wall Street and Main Street, right? And I think we can all agree to this. The professionals have a significant advantage over amateur investors. Professionals have a significant advantage, and what it does is it creates a gap between perception and reality in the financial markets. And so what we want to be able to do, the first lesson we have, is being able to understand some of the perception and reality difference that exists in the financial markets, because we've got to learn how to tune out the noise, right? Got to learn how to tune out the noise. And so let's go through a couple of common perceptions, and then we'll go through them. So here's the first one. And this is a big one. And I think that especially if you're an investor, this is something you hear. Good, high-paying dividend stocks will always come back, right? I mean, look at this list of companies: Bank of America, U.S. Steel, Citigroup, Alcoa, AIG. These are some of the oldest, most well-known, largest companies in the country. And the thing that you hear from a financial standpoint is, if you're going to invest and you want to invest safely, buy good stocks, right? Good stocks that pay a dividend, because even if the stock goes down, you're still going to get your dividend, right? And those stocks, they always come back. We've all heard that, right? Now, here's one of the things that I will say, and we'll dive into this in much deeper detail later on. The market will always come back. I believe that. I believe that the market itself will always come back, but it's not the market. It's the measurement of the market. Indexes. And we'll talk about indexes in another session. But individual stocks will not always come back. Matter of fact, there have been studies done, I think it was by the Harvard School of Business, that said that every business will eventually go out of business. And so when we think about that, remember that just because it's a good high dividend yield stock doesn't mean it's always going to come back. Look at the charts of these stocks. US Steel, Citigroup, Alcoa, and AIG. Yeah, sure, they're still traded. They're still out there. But when we look at these, it is mind-boggling how much some of these have fallen. So the one I'm going to really highlight and talk the most about is Citigroup. So let me pull up a chart of Citigroup. So as of the day that we're recording this video, Citigroup is trading at $66.90 per share, right? So we're trading at $66.90 per share in Citigroup. We can see the price of the stock right here. So that's our current price. Now we can see that Citigroup has come way up, right? From a low of 40 all the way up to a high of 80. And now we've come back down to 60. One of the things that we can see down here with these little dollar signs is that it's paying a dividend pretty regularly, right? It's paying pretty regular dividends, 51 cents per quarter of a dividend. Now, what is that 51 cents per quarter? That's about $2 a year, right? So if the stock is trading at about 50 bucks a share, that's around a 4% dividend, right? $2 a year divided by 50 is about a 4% dividend. If it's trading around 50, if it's trading higher than 50, it's going to pay less than 4%. If it's trading more than 50, trading more than 50, it's going to pay less than 4%. If it's trading less than 50, it's going to pay more than 4%, right? So that's just a good way to think about it. But it pays 51 cents. So as long as you're a shareholder, you're going to get paid something, even if the stock goes down. So you just hold on to these stocks because they'll always be back. Well, Citigroup's trading at $66 a share. That is very true. But if I look at Citigroup on a longer time period, and let's go back 10 years. We're going to look back 10 years on a 10-year chart. Actually, you've got to go back further. Let's go back 15 years on a weekly time period. Now, what this means is that each one of these little red bars means a week. Look at where Citigroup was. $570 a share. Now, a lot of you out there that are watching this may say, Chuck, I don't remember Citigroup being a $500 stock. It wasn't. Matter of fact, it was at its high, it was a $57 stock. But it did what's called a 10-for-1, a 1-for-10 reverse split. A reverse split means that they basically took most of the shares off the table, but that increased the price tenfold, right? So had they never done that, the stock would be trading at $6.69 right now. So when I look at this, what does this tell you about the myth that good, high dividend paying stocks always come back? Right? Now some of them do. There's no question. Some of them do. Some of the stocks, now this was the credit bubble, and a lot of financial stocks got hit at that credit bubble. You look at a company like Bank of America, right? Bank of America was at 55. It dropped all the way down to 2. It hasn't completely come back as of yet, but it is doing a bit better than Citigroup is doing. You look at other companies like Disney, right? And Disney fell at a 2000, and it's more than come back, right? Significantly more. And so, yes, sometimes you do have stocks that come back, but there's a perception that they always come back, and that is just not reality. So we have to be able to understand how to get ourselves out of those kind of positions, right? To not put ourselves in a position to lose too much money when the market does come hammering down. And it's not just the market, but it's individual stocks. Because oftentimes I see people get married to stocks. We don't want to get married to stocks. We might want to date them on a serial level, but we're not marrying an individual stock. All right, so let's move on to perception number 2. Perception number 2 is that investment banking firms, UBS, Morgan Stanley, Goldman Sachs, JP Morgan, right? They're concerned with long-term growth opportunities, right? That's what they care about, long-term growth. In reality, they're primarily trading, right? Wall Street has a new king as Morgan Stanley dethrones Goldman. Morgan Stanley notches $1.2 billion in fixed income trading revenue versus $1.6 million. Second consecutive quarter, their bond trading revenue higher than its rivals. It's a trading firm. JP Morgan, signs of higher trading revenue to come. Goldman Sachs, profit jumps 58% as trading revenue surges, right? Trading is what's driving a lot of these investment banking firms. Whereas, what do they tell us, right? These investment banking firms, they don't tell us that. What they tell us is that you should buy and hold, right? Buy and hold in the financial markets. Oftentimes people don't think about these companies as really being trading firms, but in reality they are. So let me give you an example, and I'm going to pull up Goldman Sachs 10K report. Now you can see here that I'm at goldmansachs.com/investor relations. So I'm at their Goldman Sachs 10K report. And we're on page 101 of their 10K report. And this is a very long page, but I want to show this to you so that you see it's not just me saying it. This comes from what they do. So they have something that they call VAR, value at risk, essentially. And this is how much money are they willing to lose in the event of the market movement. Now, interestingly enough, in 2020, that was the year that we saw how COVID just absolutely rocked the economy, right? I mean, we had a huge decline in the markets. But notice how Goldman Sachs risk rocketed up during that period. I'm going to zoom in on this a little bit so everyone can see. This chart below represents our daily value at risk, meaning that when the rest of the country was losing their mind, the rest of the world was losing their mind, Goldman was willing to take more risk, right? Because they saw that there was a tremendous amount of opportunity. So when we see that the markets rocketed back up after the decline, right in that February-March period when COVID really started to impact the economy, it was the institutional investors that were willing to take the risk in order to move higher. Now, the interesting thing below that shows the net number of business days, the frequency distribution of our daily net revenues. Now, this would be their trading revenue, right? Taking a look at this, there's 253 trading days in the year. So out of the 253 trading days, their number of losing days were 11 plus 8 plus 3 plus 2. So what is that? 24 losing days. So out of the entire year, they had 24 losing days. Look at the rest of the year, right? They had 50 days where they made greater than $100 million in a day. They had 37 days where they made between $75 and $100 million in a day. So what this shows me is that these companies understand, okay, we need to win more often than we lose, right? Certainly have to win more often than we lose, so that's key. But then also notice how many days of loss did they have over 100 million? How many days of loss did they have over 100 million? The answer would be 0, right? How many days of loss did they have between 75 and 100? They had 2. 2! Yet 37 days where they made over 75 million. So if we just 87 days. So if you think about it, they had 87 days where they made over 75 million and only 2 days losing that much. So what does this show me? What this shows me is that these institutional investors understand that it's okay to lose. Now, they're going to lose a lot less than we are because they're oftentimes controlling the market. But in reality, what I'm looking at here is that they keep their losses small and they let their winners run. Well, why can't we do the same thing, right? Yet we're told as investors, buy and hold, right? Hold and invest for the long term. But that's not what they do, right? Do as I do, don't necessarily do as I say. That's a great way to think about it. So let's talk about another one, another perception. Strong earnings, they have an immediate impact on a stock price, right? So this was analysts going crazy over Q3 earnings for Facebook. And in reality, that particular day, the stock drops on record earnings and analyst upgrades. See, the news oftentimes, especially in the smaller time period, will just be an opportunity to bait the novice investor, right? The news will sometimes just be an opportunity to bait the novice investor. What we want to be able to do is to see what happens to the market regardless of the news, right? Identifying good opportunities where the news doesn't necessarily matter. So one of the things that we want to remember is this. Perception and reality are key. But the greatest reality of all is that there's only one thing that can never be improperly perceived. One thing. It's price. Price is the only truth in any market. That's all it is. So the only truth in any market is price. And so what we want to be able to learn to do is to tune out all the noise. We want to put on our noise canceling headphones. And once we put on those noise canceling headphones, we want to tune out all the other noise that happens out there in the world. So in our next sections, we'll start to talk about price and being able to see some changes in price.